transferred appreciated property, if you transferred appreciated property to a company and you receive stock in return or anything else in return, it would be at the fair market value of what you gave up. But a lot of what you gave up may have been depreciated, for example. So normally, and this is what I have down here, potential gain. Potential gain, fair market value of what we received, which should be the fair market value of what we gave up, minus the adjusted basis of what we relinquished. This is a relief section, kind of like 1031, 1033, some sections we've seen before. Notice section 351 at the top. No gain or loss is recognized in the transfer of property to a controlled corporation. Now that won't be an issue in our class, but there's another. Don't you love all these tests? Remember when we talked about depreciation, we had the 40% mid-quarter convention test. We had the 80% test for residential rental. I love all these tests. To be a controlled corporation, the group transferring property must own at least 80% of the stock of the company. Pretty much it's usually voting stock. That will be met in our exam. So if you exchange property solely in exchange for stock of the company, then you don't have to recognize a taxable gain. Now go further down. There are two possible situations in which gain might be recognized. Not again to exceed the gain realized. One, if you receive boot. If they give you cash, we're going to do some problems on the board with numbers. I got some supplemental problems that are excellent here we'll be doing with the spreadsheet. If you receive cash, that's boot, like it was for 1031. Or if you receive something like corporate bonds, that's boot. Or there's an excess of any indebtedness on property transferred over the basis of all. What is he talking about? Bill, please. The excess of any indebtedness on property transferred over the basis of all property transferred. Let's go through an example here. Let's say that I have property worth $100,000 that I'm going to give to a corporation solely in exchange for stock. So there is no boot. There's no boot. The adjusted basis of the property is $40,000. It consists of land with a basis of $20,000. It's subject to a mortgage lien of $30,000. And I'm giving cash of $50,000. 50 plus 20 is 70 minus 30, that's the 40,000. Gain realized 60,000. I didn't get any boot here, so that cannot trigger any gain. But does the liability exceed the gross basis? Does the liability exceed the gross basis of everything that I distributed? Now it exceeds the basis of the land, but notice the gross basis of what I gave up is 70,000. The lien is less than 70,000. It's less than 70,000, so that means that triggering event does not occur because the gain does not exceed, the liability does not exceed the gross basis of what I distributed. Bill, are you going to show us some situations where it will? Yes. Over here, situation E and George. Basis of stock received. This is by the transferor shareholder. Guy distributed property, got stock. Carryover basis of the property transferred, plus the gain recognized. Notice that you often get a step up in basis when you have a taxable gain. Plus the gain recognized, minus liabilities to which the property transferred is subject, minus boot received. Bill, this is Greek to me. I hope you're going to show numbers. Yes, we're going to work something out together. Basis of the property received by the transferee corporation. the one that we're transferring property to, and we're receiving, we are giving them stock in return or stock in something else. Their basis in the property is your basis. But this is something that's fascinating to me. Fascinating. If the transfer shareholder has a taxable gain on the 351 transfer, then the transferee corporation, who is a separate taxpayer, gets a step up in basis. I find that extremely unique. And Fonnie put a little asterisk down there at the bottom. Note, there is no gain recognized by the transferee corporation in a 351 transfer. Bill, this is Greek to me. Well, we're going to look at some problems together. And I think I'll do one, and then I'll have you do one, and we'll kind of go back and forth. Then we have just a wrap-up sheet of some miscellaneous topics.
Is sub-S corpse on the plan?
This normally applies just to C corps.
But I mean, in general.
Oh, S corps on the exam?
Yeah.
No. No, they don't have S corps and reorganizations. None of those are on the exam.
Oh, neither one of them.
Neither one are down there. Now, in accounting 429, they're a real big part of their exam. It's interesting because the exam for some of those undergraduate classes are harder than they are here. No, this is their exam, and that's one reason I wanted you to get into those topics for the research paper.
Yeah.
Because they're not, I didn't take them out, they weren't in there. They just were not in the coverage. Now, the main reason may be there is an advanced tax class that's never been offered live, that's online, that emphasizes more of those. So that might be where they test that area. Okay, there's some supplemental problems. We're not going to do shareholder A, but we're going to do the others. Using Bill's spreadsheet, because that's the kind of thing I'm going to want you to be able to do on the exam, for those of you who get this area.
Thank you.
Ooh, got just a ton. I'll leave one here for me. All right, let's look at shareholder A. Then I'm going to be up at the board for a few minutes. Excuse me, cross off shareholder A. We're going to do shareholder B, C, D. Then I'm creating a hypothetical shareholder E. And then we'll do George at the bottom. And we're doing pretty well on time. We're just kind of relaxing here. We know we won't have flooding on the way home tonight, so that'll be nice. Okay, yes. Shareholder B, this is problem 49. He is contributing cash of $40,000. Let's make the property land. Land worth $45,000. His basis is $30,000. He's getting boot of $5,000. That means automatically there'll be some gain here because he's receiving boot. That could be corporate bonds. And he's going to have a 40% interest. Okay, well, let's follow our format here on the board. First of all, let's get the fair market value of what he is receiving. I assume it's the same as the fair market value of what he is giving up. What's the fair market value, obviously, of the cash he's giving up? The cash. 40, same as fair value, same as face value. So he's giving up $40,000 worth of cash. And what's the fair value of the land that he's giving up? It's $45,000, yes. So he's giving up $85,000 worth of property, so we assume he's getting $85,000 worth of property in return. Stock, but it looks like there was something else there as well. What is the adjusted basis of the cash that he gave up, the cash? hint is the same as the fair value. 40. What's the adjusted basis of the land that he gave up? 30. Good. So it looks like without code section 351, he has a $15,000 gain realized. But there are no liabilities here. But he is receiving booth. So what would be the taxable gain, the gain recognized? What would be the taxable gain? 5,000. Now let's do the basis of the stock he receives. The basis of the property transferred was 70. He has a taxable gain of 5. No liabilities. Boot received, yes, 5. So it looks like his basis of the stock he gets is 70,000. Corporation now is getting $40,000 worth of cash. There are no liabilities in this one. There will be in D, though. Basis of the property that they receive will be the same as his basis. That was the 30,000. They get a step up in basis for the land of 5 because that's the taxable gain that he had to pick up. So they will pick up the land for tax purposes at 35,000. And I'll stop, let you get caught up. And when you get done copying that down, you do shareholder C. Then I'll do D. And I'll let you do my hypothetical shareholder E. It's a union job, we're splitting the duties. Write it down and start shareholder C. Shareholder C is pretty easy because there's no liabilities and there's no booth. Try and do the whole spreadsheet. Don't do D yet because I want to show you a different way of doing D. Notice shareholder C is contributing cash of 20. He is contributing land worth 20. His basis is 10. No boot, no liabilities. Let's look at shareholder C here. What's the cash that he gave up? C? 20. What's the fair value of the land? 20, good. So that's 40. Adjusted basis of the cash would be the 20. What's the adjusted basis of the land?
10.
10, good. 30, good. 10,000 gain realized. Any gain recognized?
No.
No, because there was no boot and there's no liabilities, which is obviously discouraging you, but we'll do disappointing you. We'll do liabilities in this one, and that one, and that one. Basis of property transferred, 30. Gain, liabilities, no boot, how boring. 30,000. Symphony Corporation, there's no liabilities. They got 20,000 cash. And they'll pick up the land, I guess, at 10,000. Give you a chance, you probably already copied that down, but give you a chance. Then I got to bring out two new colors, because I want to show you my approach to doing the liabilities, which is a little different from their approach. And there will be some liabilities involved in our exam possibility. Some of the problems on this final are Becker problems. So you'll see when you take the exam, Becker. Just like they've had a little bit of, that a couple of the weeks they had a little lecture part in the week. I was looking at the auditing class because a couple of people are going to be in auditing with me, and a lot of Becker stuff there in the course shell, which is good. Anyone with us so far? All right, we're going to do Bill's approach to shareholder D. Then I have a hypothetical shareholder E that's not on this sheet. Then we'll go and do George at the bottom of the sheet. Shareholder D contributes cash of 20. Land worth 60. His basis is 30. No boot, too bad. But there's a lien on the property of 40. That will be assumed by the transferee corporation. Okay, we're going to have multiple colors here. We'll start off with the cash. He is contributing 20,000 of cash, so we'll put 20. Land that's worth 60. Now we're doing Bill's approach. I'm going to back out the $40,000 lien. Because to me, basically, he's giving up $40,000 net worth of property. So that should be what he receives in return, $40,000. Because the transferee corporation is going to pay that liability. Adjusted basis, $20,000 on the cash. The land had a basis of 30, in his hand, 30. Now, notice that equals 50,000. That's the gross basis of what he's giving up. Back out again, back out the 40,000. Back out the 40. This would be 10,000. So the gain realized then looks like it would be 30. Now, he did not receive any boot. Does the liability exceed the gross basis of what he contributed? This 40,000 is less than the gross basis. It's similar to the example that was over here. So notice there is no liability in excess of basis. There's no boot, so the gain recognized is zero. Bill, can you show us one where there is a liability in excess of basis? Yes, but that's my hypothetical shareholder. Now, look at what we're going to do now. Basis of property transferred. I'm going to take this 50,000, so I'm going to use green. Plus gain? No. Liability? Yes. 40,000. Boot? No. 10,000. Recipient shareholder, transferee corporation, they're getting $20,000 cash. Excuse me. Yes, 20,000. That's what I thought. They're picking up a liability of 40. I'm putting that in red to accentuate it. It's a liability. Now, his basis of the land was 30. There's no taxable gain, so they got no step up. So they'll pick up the land for tax at 30. Now, bless you, bless you. There is no shareholder E on here. So I made up a hypothetical shareholder. E is the same as D, except the liability is not 40,000, it's 60,000. So I'd like you to do shareholder E, this hypothetical shareholder, and use for the lien 60,000. Gives you an interesting mathematical result. Do 60,000. So it should be pretty similar to what we had for D, except it would be 60 rather than 40. So work on that. Yes, yes it is. And to see when you come up with the gain realized, think about a number line, or some people like to do fancy math. I was never into math that much. My ex went back and started teaching high school math, and she liked to make number lines up, and then laminate them. Work on this shareholder E that I've added. Same as D, lien of 60,000. done. So let's take a look. We can start the same way. 20,000, 60, back out 60. Remember to back it out both places. Looks like 20,000. 20,000 here. Let's put this. 30. Be my green. This is 50 still. Back out to 60. This is what Tracy was talking about. -10, yuck. Now, I like to think of a number line. Some people are more mathematically oriented. What is the difference between positive 20 and negative 10? 30. Now, there's no boot here, but does the liability assume the gross basis of what we contributed? Yes. 60,000 exceeds 50,000 by how much? 60,000 exceeds 50,000 by how much? 10,000. So we've got a gain recognized here of 10,000. Now let's finish the other stuff here. And we'll stop a second again. Base of the property transfer, that's this. Gain, yes, 10. Taxable gain of 10. Minus 60. No boot. 0. If this comes out to a negative number, you made a mistake. But it can be 0. 0 basis in the stock. So if he sells the stock, anything he gets will be gain. Over here, 30,000 plus 10. That's 40. They're getting that step up in basis because of his taxable gain. 20,000 of cash. I'll stop a second again. Then we have like our capstone, which is George. And the $60,000 liability to be assumed for tax purposes by the transferee corporation. I want you to look this over next week before our final exam review. We got a problem where I think this should all be all you need. We have a problem where some individuals are transferring property, which there'll be no boot, but there will be liabilities. And they may be in excess of basis, who knows? So get that done, and meantime, start reading about George. Read about George. That's back to our sheet here. George is at the bottom. Good old George. Or go ahead and start. You want to start, George? Go ahead. George is interesting because he has both boot and liability in excess of basis. That's what's kind of like a capstone, brings it all together. And this is a topic in the online discussion this week as well, so another chance for us to look at it. Making any sense, everyone, or is it just at this late hour, nothing makes sense? Probably a combination,
A little both.
yeah. A little bit of both, right? Don't forget on Monday, we're in 118, there's the next room over. Work on George. Give me another couple of minutes, and then I want to do George, and then I want to do my final sheet. Okay, let's start looking at George. George can exchange his property with a fair market value of $300,000. So $300,000. And it's got a lien on it of $250. Wow. So it looks like that's a net of $50,000. He's getting treasury stock, that's stock of the company, that's fine. And his basis is $200,000. Looks like this lien exceeds the basis. Negative 50. Now, what's the difference between positive 50 and negative 50? Positive 50 and negative 50. Picture a number line. This is 0. This is plus 50. That's minus 50. How much distance do we have? 100,000. So we have a $100,000 gain realized. Now, I think I need another color up here. Gain recognized. First of all, we have the liability exceeding basis. The 250 exceeds the 200,000 by 50,000. So it's like a two-barrel shotgun, and that barrel is now going off. Liability exceeding basis. Plus, we have boot. He is receiving cash. He is receiving cash of 5,000. And he's receiving U.S. government securities, like T-bills, of 5. So it looks like we have $10,000 worth of boot and liabilities in excess of basis of 50. So that looks like 60,000. I'll use it. I'll stay with boot. I mean, he's still getting a break, because without section 351, he'd have $100,000 taxable gain, and notice he's only got $60,000. Now, basis of the stock received, the basis of the property transferred is $200,000. Plus 60 for the gain realized. Minus 250. Oh, my thumbs are getting a nice workout here. Minus the boot of 10. Remember, this cannot end up negative. If it does, you've done a mistake. Lo and behold, basis of the stock, 0. Plus 260, minus 260. Basis of the property received by the corporation, 200,000, same as his, plus 60. So that'd be 260,000. They gave him cash, he didn't give them cash, so there's no cash over here. And a nice juicy loan that they got to pay off of $250,000. I'll get out of your way and let you get that down while I pass out our last handout of the evening. There's some outdated information on this sheet that I'll mention, and there's some other good stuff. Before we meet on Monday, isn't that far off, we'll be, please look at some of this material. So when we talk about the exam on Monday, you'll be, oh yeah, the camera shot time today, please, please. Take shots before you leave. So we'll be able to address all questions at our Monday class. It may run the whole time if you need it to. If it's going to be shorter, that's fine. I'm allowing the whole time here just to make sure we can go through the exam leisurely and talk about every aspect.
Any questions with the exam?
There's a 16 multiple choice, although in these multiple choice you don't have to show the computations like with Bill's. And then there's like 10 problems. They said 3.5 hours. I think that was way too little. You say, well, Bill, 4.5 hours you're giving us. Oh my God. As you know from these exams in the classroom, time goes quick. You know, when you're working on an exam here, before you know it, oh my God, another half hour has transpired. Okay, well, let's talk about this last sheet here. These are some other topics that I found, although one of these items is outdated, and I think someone's already addressed it in the outline discussion. First of all, organization costs, costs associated with the establishment of a new company. I've had personal experience with this area. Legal fees associated with the filing of the articles of incorporation of a new company. Legal fees associated with the drafting of the bylaws, you know, the rules that which the company is governed. Fees sent to the Secretary of State where the company was incorporated. Travel and related costs to the incorporators and the temporary directors. Not an organization cost. Expenses for the issuance or sale of the equity stock or securities. Those are an adjustment to paid in capital. Now, see the next two lines? Put down outdated. Or this was the rule for 50 years and they changed it. Organization costs were amortizable over not less than 60 months, etc. It is now 180 months. 180 months. But, and some people I think have already posted this, there are extra complexities because there are special benefits for small business. So there's a special rule for startup costs with like a phase out like we had for the 179. That's why if you can stomach this tax area, there's always work. I mean, here we go again now with this idea of, well, is this small business? Then they can expense directly without doing the 180 months a certain dollar amount of like startup cost. So that is outdated here. The basic rule is 180 months. Check the online discussion. If you find a different source from what's already been posted, you can certainly post that other source. I think someone also talked about the charitable contribution deduction. This is in one of the two classes. You can see what it is there. I think Tracy did something on dividends received deduction. Remember, corporate shareholders who own stock in other corporations can exclude a significant portion of those dividends from taxable income. And if they file consolidated, I think you said, did you just finish the Consolidations 559 course?
I did advance that had consolidations in
Okay, yeah, that advanced, there used to be a course that was 10 weeks long here taught only by Bill. That was 10 weeks of consolidations. The rules for book and tax are actually rather similar. Now they have what, foreign exchange and partnerships or something.
Yeah.
So they diluted the consolidations part. But as Tracy can tell you, anytime you have intercompany transactions, those are basically excluded from taxable income until there's a transaction with an outside third party. There are some exceptions for like depreciable assets because of the different depreciation on the books of the parent and the sub. There's all this upstream and downstream stuff. Is it sub to parent or parent to sub? Did you think it was a hard class?
Yeah, it was the hardest class I took.
That's what I thought. Tax in that class are the hardest courses in the program. But again, I put intercompany transactions in there and so forth as well. Some of you have already talked about the advantages of consolidated tax returns. There are some limitations that exist as well. And there are certain types of entities that even if you have 100% ownership, you cannot file consolidated. And that's those are down below here. FISCs, REIT, these are real big right now, Real Estate Investment Trust. Especially big for like a group of investors buying a shopping center. Regulated investment companies that I personally have never dealt with. And that's because these have their own specialized tax forms. Used to be life insurance companies. I used to handle Fort Dearborn Life Insurance when I was at Arthur Anderson. And at the time they couldn't file consolidated because they had special tax rules. Now they can because they changed some of the rules. So these were some of the other topics I thought that were of interest, except the organization cost on this part is outdated. Now, as I said, next week, on Monday, in the room through the yellow wall there, where we'll start talking, maybe we'll do the multiple choice first, and then we'll start talking about the problems. And if you have questions over this material we've gone over, not just tonight, but any of the previous nights, especially like things like depreciation, I'm going to bring all that stuff with me, and we'll go over it, however long it takes, you know, so you feel comfortable with it. And then the exam will open Sunday, but I think you should wait till we've had our class. Although if you could complete it by Wednesday or Thursday, it'll make my life easier. Because this is graduation that weekend as well. I had to go to two graduations a year. So in January, I went to both graduations, the morning and the afternoon. Now the dean is saying, I got to talk to you about attending graduation in June. Well, I already did the two. I thought I would go to just the Keller one, but he's looking for another two. And the Keller one's in the morning at 10. The undergraduate is at 2. So it's a day where you're there from like, if you're faculty or administrators, you're there from 9 till 5. But it is a nice place. It's the Rosemont Theater. It's kind of nice. All right, any last minute ideas, everyone? Is everyone wasted now from all this material?
Yeah, it's a lot of material.
Oh, I told you it is. I have no new material next week, just going over the exam stuff. So there should be no new content. I have a new handout I want to give you next week. Maybe I'll give